In this video, we'll learn about multi-time frame analysis. This is a powerful but simple trading concept. It means analyzing the market using more than one time frame. Why is this important? Because one time frame does not show the full picture. Higher time frames show the overall trend. Lower time frames show entry opportunities. Think of it like this. The higher time frame is the map. The lower time frame is the street view. First, start with the higher time frame. For example, the daily or 4-hour chart. Ask one simple question. Is the market trending up, down, or sideways? This gives you directional bias. Next, move to a lower time frame, such as the 1-hour or 15-minute chart. Now look for entries in the direction of the higher trend. This increases probability. For example, if the daily trend is up, you focus on buying opportunities. You avoid selling against the bigger trend. This reduces bad trades. Beginners often make one mistake. They trade only on very small time frames, without checking the bigger picture. This leads to confusion and losses. Multi-time frame analysis adds clarity. It aligns your trades with market structure. But keep it simple. Use only 2 time frames in the beginning. One higher time frame for direction. One lower time frame for entry. Do not overcomplicate it. Trading works best when it is simple. Quick recap. Higher time frame shows the trend. Lower time frame shows entry. Trade with the bigger direction. In the next video, we'll discuss chart zooming mistakes beginners make.